In the United States, you can do everything right and still get punished by a number you didn't even know you were playing for. It's 3 digits, and it decides what kind of life you get offered. Not your talent, not your work ethic, not your character. Your credit score can decide whether you get a home or a sorry, we went with someone else. Whether your car payment is manageable or a slow monthly chokehold. Whether you pay a normal insurance rate or an invisible, you're risky tax that follows you for years. And here's the uncomfortable part. Most people think a credit score measures responsibility. It doesn't. It measures profitability and predictability for lenders. So in this video, I'm not going to tell you how to fix your credit. I'm not going to sell you a checklist. I'm going to explain why this system exists, how it actually works, and who quietly makes money every time that number moves. Because once you see the machine, you stop blaming yourself for getting chewed up by it. Let's start with the origin story. Credit scores didn't come from some neutral, government-designed truth machine. They came from a problem lenders had. For most of American history, getting credit wasn't automated. It was personal. A banker would look you in the eye, maybe know your family, maybe know your job, and decide whether you were trustworthy. And that kind of system had 2 big issues. 1, it was inconsistent. 2 different banks could treat the same person completely differently. And 2, it was biased. Not subtly, openly. If you were the wrong kind of person in the wrong neighborhood with the wrong last name, you could be denied even if you were financially solid. Then America scaled up. More people, more credit cards, more car loans, more mortgages. Lenders didn't want to rely on gut feelings and local judgment anymore. They wanted something faster, something standardized, something that could turn a human life into a quick yes or no. And that's the moment this system starts to make sense. Not as a moral score, as an industrial tool. Credit bureaus, companies that collect data about your borrowing behavior, expanded dramatically. And then scoring models came in to turn that data into one number. The most famous name is FICO, created by the Fair Isaac Corporation. And the pitch was simple. We can predict risk. Not your worth. Not your potential. Risk. Meaning, what's the chance you won't pay on time? From a lender's point of view, that's the whole game. Because if they can predict default risk, they can price loans differently. They can charge more to people who look riskier and less to people who look safe. And that spread, the difference between those rates, is where a lot of profit lies. So the score becomes a gatekeeper, but also a pricing engine, a quiet sorting machine. Now let's talk about what the score actually measures, because this is where people get emotionally trapped. Most people think their score is like a grade in school. Like, if I'm responsible, the score will reflect that. But credit scores don't grade responsibility. They grade behavior patterns that statistically correlate with repayment. And that sounds similar, but it's not the same thing. For example, your income is not the main driver of your score. You could make 6 figures and still have a mediocre score if your credit behavior doesn't match what the model rewards. And you could make a modest income and have an excellent score if your behavior matches the pattern the system likes. So what patterns does it like? It loves consistency. It loves predictability. It loves you staying in the game. Meaning, using credit, managing credit, and continuing to exist as a credit user. That's why missed payments hit so hard. Because the system is obsessed with, do you pay on time every time? A single late payment can drag you down because it signals the one thing lenders fear most, uncertainty. And here's one of the most frustrating truths that makes people feel crazy. Paying off debt can sometimes lower your score. Not because you did something wrong. Because the score isn't celebrating your freedom. It's reacting to the change in your credit profile. If you pay off a loan and close an account, you might reduce your available credit, change your utilization, or shorten your active credit mix. So the score can dip. And imagine how that feels emotionally. You finally do the responsible thing, finish paying something off, and the system goes, we don't like this version of you as much. That's when people start feeling like the whole thing is rigged. And in a way it is. Because it was never designed to reward the feeling of being debt-free. It was designed to predict your behavior as a borrower, which means the model tends to favor people who have long-standing relationships with credit products. The system likes an old, stable credit history. It likes accounts that have existed for a long time, which means if you're young, or you avoided credit, or you grew up in a household that didn't use it, you start the game behind. Not because you're less responsible, because you have less data. and the system doesn't trust what it can't measure. So credit scores become less about are you good and more about are you legible to the machine? Now, who profits from this? Let's name them clearly. First, lenders. Banks, credit card companies, auto lenders, mortgage lenders, anyone who makes money by lending money. A credit score helps them decide whether to approve you, but more importantly, what price to charge you. A higher score can mean a lower interest rate. A lower score can mean a higher interest rate. And that difference isn't just a number. It's thousands, sometimes tens of thousands, over the life of a loan. So if the system can push a chunk of people into higher rate territory, that's a steady river of extra money flowing in every month. Second, credit bureaus. These companies collect, store, and sell your credit data. And you didn't hire them. You didn't sign up for them the way you sign up for a streaming service. They exist because the financial system uses them as infrastructure. They make money when lenders, landlords, and others pay to access your file. And that's a weird feeling when you really sit with it. Your life is being tracked in a data warehouse, and that warehouse makes money off your existence. Third, credit scoring companies and credit monitoring ecosystems. There's a whole economy built around the anxiety of that number. Monitoring apps, premium subscriptions, identity theft protection bundles, score simulators. A lot of it is framed like empowerment, but it's also a business model. Because once people believe the score controls everything, they will pay to watch it like a heartbeat monitor. Fourth, insurance companies. This one shocks people. In many places, your credit-based insurance score can influence what you pay for auto or homeowners insurance. Not because you're a worse driver, not because your house is more flammable, but because statistically, insurers believe credit patterns correlate with the likelihood of filing claims. So the score becomes a pricing lever in yet another industry. And it often happens invisibly. You don't get a big dramatic letter saying, "We think you're risky because your credit looks risky." You just get a higher quote. And if you're already stretched thin, that higher quote doesn't feel like data science. It feels like life is punishing you. And that's the real power of this system. It creates extra costs that look like just how things are. Now let's bring it into the real world. Mortgages first, because this is where credit scores can literally shape the map of your life. Two people can buy the same priced home, same neighborhood, same builder, same layout. But if one has a high score and one has a low score, their monthly payments can land in completely different universes. One person builds wealth more easily. The other bleeds interest. Not because they're morally worse, because the machine priced them differently. Now renting. A lot of people assume credit scores matter for buying, not renting. But landlords often use credit reports in tenant screening. So if your score is low, you might get denied, even if you have a steady job and enough money right now. And if you do get approved, you might be asked for a larger deposit, or you might be pushed toward worse housing options. So the credit system doesn't just affect loans. It affects access. It affects stability. It can decide whether you live in a safe area close to work or far away, with longer commutes, higher stress, and fewer opportunities. Car loans. This one is brutal because cars in America aren't luxury items. They're survival equipment. If you can't get to work, you can't keep the job. If you can't keep the job, you can't pay bills. So if your credit score is low, you might only qualify for a high-interest auto loan. And that can turn a basic vehicle into a financial trap. Now credit cards. This is where the system feels almost predatory, because the people who can least afford high interest often get charged the most. Higher APRs for lower scores. Lower limits. More fees. And sometimes you'll hear someone say, "Well, that's because they're risky." But risk doesn't erase the reality of what happens next. Higher interest makes it harder to escape balances, harder to get ahead, harder to save. So the pricing model can reinforce the very instability it claims to measure. And then there's employment. Not every job checks credit, but some do, especially roles involving money or sensitive access. Even when it's not technically a credit score, credit history can show up in background checks depending on laws and company policy. So the system can follow you into your career. And that creates a specific kind of pressure. When you're struggling financially, you're not just fighting bills. You're fighting the downstream consequences of struggling. Now let's talk about the lifetime cost difference, because this is where the emotion gets heavy. If you get lower rates, you can borrow cheaper. If you can borrow cheaper, you keep more of your money. If you keep more of your money, you can save and invest. If you can save and invest, you become more resilient. If you become more resilient, you're less likely to miss payments in the future. Meanwhile, if you get higher rates, your money leaks out through interest. If your money leaks out, it's harder to build a buffer. If you don't have a buffer, one surprise expense can trigger late payments. Late payments drop the score. Lower score raises costs. And suddenly you're not just behind. You're paying extra for being behind. That's the loop. And once you're in it, it doesn't matter how hard you work if your margin is thin. That's why people feel stuck. Because they are not imagining it. The system is designed to price uncertainty higher. And poverty creates uncertainty. So people misunderstand the game and blame themselves. They think, I'm irresponsible. Or, I'm bad with money. But sometimes the truth is more painful and more freeing at the same time. You're dealing with a system that converts financial stress into higher costs. So what keeps it going? Incentives. The system is incredibly useful to the companies inside it. It creates a shared language for risk. It makes approvals fast. It makes pricing easy. And it shifts the conversation away from messy human stories and toward clean numbers. A lender doesn't have to understand your life. They just have to understand your score. And the score isn't there to tell your story. It's there to make you sortable. Now, does that mean every part of it is evil? Not necessarily. Standardized scoring did reduce some forms of subjective judgment. But it also created a new kind of power, algorithmic power, where the rules are not always obvious to the people living under them. It's like being judged by a teacher who never tells you the rubric. You just get the grade, and then you pay the price. That's why someone can say, with full sincerity, I paid everything. I worked overtime. I stayed out of trouble. Why am I still getting rejected? And the answer is, because the system isn't measuring what you think it's measuring. It's measuring how your borrowing profile fits a risk model. And the risk model doesn't care that you're trying. It cares whether you look statistically like someone who will pay on time with the patterns it recognizes. So here's the closing thought. Understanding the system doesn't change it overnight. It doesn't magically make the number stop matching. But it does something important. It gives you the real explanation for why so many people feel like they're doing everything right and still paying more. Because for millions of Americans, that extra cost isn't about bad choices. It's about how the machine is built. More explanations coming.